And chat about where the market is headed next in the much medium and longer term, and what exactly are data points indicating in terms of what the investment tilt sectorally should be. Who better than Anish Tawakley, the CIO at DSP Mutual Fund, joining in on the show right now to talk about exactly that. Anish, hi, great to have you in the studios today. Anish, the high frequency data along with earnings, that's definitely surprised on the upside. Do you think the market has factored all of that in though?
Well, the data is pretty good, right? And I've been saying for a while that the economy is actually in pretty good shape. Difficult to say whether the market valuations are not cheap, right? But I'm not playing for a multiples upgrade. I'm playing for more for an earnings growth story. So I think over the next 2 to 3 years, we should see steady earnings growth. And then irrespective of whether the multiple moves up or down a little bit, one should make reasonable returns in the market.
Anish, we saw the governor also, highlighting that, for now the stance is neutral, but he's also saying that we may have to recalibrate the rates going into early next year if inflation, which is a factor of El Nino, monsoon, geopolitics, and the second order impact comes into play.
Right.
What is your house view on that?
See, the way I think about it is that you have to distinguish between one-off inflation, a one-off change in prices, versus recurring inflation. Recurring inflation only happens when demand exceeds capacity. Demand in the economy exceeds capacity. And we are not there yet, right? What we are seeing is demand is picking up, but there's still spare capacity in the economy, right? So while you might get these one-off moves because there's, supply side factors like an oil shock, whatever, that does not trigger recurring inflation. And as long as that's not the case, there's no case for hiking. Now, if we say that, look, the economy performs so well, the demand actually starts matching capacity, and then the RBI has to raise rates. That's a good problem to have, right? If you're saying, look, the economy is in such good shape that there's no more spare capacity, and the RBI has to then raise rates to curb demand, that's a wonderful problem to have, and I hope we get there.
What about the capex cycle? Do you start to see signs that we're underway? Just trying to follow up on what you've just said.
See, I actually have been struggling to see why people say there's been no capex, right? Let's look at the sectors that do heavy capex. Steel has added capacity, cement has added capacity, auto has added capacity, power has added capacity, and home building is happening. So why do we say that there's no capex in the economy, right? A lot of capex has been financed by equity investment, right, rather than bank borrowings. But capex has happened in the economy. I'm not in the camp that there's some dearth of capex. To the extent that we would like to have more capex, look, capex always follows capacity utilization, right? Nobody will add capacity if there's spare. Nobody is going to add capacity if you're sitting on spare capacity. Right. So as demand picks up and capacity utilization improves, I would expect a further step up in capex, but I'm not at the starting point of saying, oh, there's been no capex, there's been no capex.
But the capex, is concentrated in certain sectors. So that's the point you're making. The second point that you're making is that how should therefore one look at consumption in particular? Because that we're not seeing, at least in certain pockets of consumption, we're not seeing a significant pickup. Of course, auto and the like have done very, very well. But there are some pockets which aren't doing well at all.
See, the pocket everybody talks about is FMCG.
Correct.
Right? And my view on that is it's not that there's not FMCG consumption or that FMCG consumption is weak. It's that the companies that we track are losing market share, and they're losing market share because they're underinvesting in the business. Right? Their margins are at too high, so their margins are all at 25-year highs. And when margins are that high, that means that there's not enough money for product innovation, marketing, brand building, all of that stuff that is required to stimulate demand for your products. So what we are seeing is a shift in demand is healthy, but there's a shift in market share, which then reflects in weak revenue growth for the companies that we track.
But Anish, all these high frequency and macro points, data points, how do they translate into what one's investment should be, up until a year from now?
So basically the way I think about it is there's top-down investing and there's bottom-up stock picking, right? Top-down, I only take a view on the economic cycle. Sure. And when the high-frequency data points are strong, and particularly I look at 4 variables actually. I don't look at 10,000 variables. I look at power consumption, cement demand, automobile, and housing, right? And if those 4 numbers are healthy, that means the demand in the economy is strong. Now, if you have a situation as we have today where demand is healthy and there is still spare capacity, that means the cycle is still an upside, right? So I would pick sectors that, from a top-down perspective, that benefit when you have a strong economic cycle, right? When you have a cyclical recovery. So those would be stuff like auto, cement, financials, capital goods, insurance also, insurance and banks, both of them. Auto is also looking pretty good. So that's the top-down sector selection perspective, given on where we are in the economic cycle.
But would you not say that these positives and this gap between where the capacities are and where the demand could actually rise up to is already in the price, at least when it comes to autos? I mean, these are not cheap multiples to buy or even add positions in autos.
Yeah, but look, we can have an endless debate on multiples, right? I mean, there's no real right answer on whether the multiple should be, like even at the market level, right? Whether the multiple should be 21 or 19. We can debate that endlessly. That's why I say if you take a 3-year view and you say you'll get healthy earnings growth, you put a number, I'm not allowed to put a number, right? But if you put a three-year healthy earnings growth, and even if the multiple compresses from 21 to 19, you're still okay. I mean, you're not delighted, but you're still okay. So I don't like to get into this debate of whether we should be at 21 times or 19 times, frankly, right? It's more the earnings momentum, and then you just have to stay in the market for as long as the earnings momentum lasts.
But earnings momentum is not coming that much, right? Means if you look at Q1 numbers, it's better than expected compared to what we expecting in April. The July, August numbers have been much better. But it's still a muted growth which is coming in compared to your emerging markets. And the flows which you spoke about, earning momentum brings in momentum of flows as well. And if you see in the last 10 years, the kind of foreign flows have come in. Last 3 years, it's wiped out almost entire flows from the market. So how do you look at flows? So, of course, we have a domestic institution supporting us, and that's holding up the valuation as well.
So firstly, I'll break up earnings momentum and flows, right? So earnings momentum is healthy. I'm not saying it's great, but it's healthy. Now, as far as, and within earnings momentum, I think, look, if you take out OMCs, then earnings are pretty strong in Q1, right? They're high teens. Some of that is supported by financials, where some of them I'm worried about. So even if you exclude OMCs and financials, it's still mid-teens earnings. That's pretty good, right? Now we come to flows. See, I break up things into stuff that you try to predict and stuff you react to. I don't try to predict flows. I react to flows, right? So if people are selling and the earnings are good, and because flows only impact multiples, and if stuff becomes cheap despite good earnings, you buy. That's what I mean by you react to flows, right? So if there's somebody coming and selling when the earnings outlook is good, you should be buying. I don't try to predict flows. The reason I don't do that is because there's no good model for predicting flows, right? Second, if you're buying because of flows, expectation of flows, you're buying on a greater fool theory. I wouldn't like to do that. Third, and we've seen that, right? You can have strong flows for demand, but then supply also picks up, right? Promoters, private equity, everybody realizes, that there are people who are willing to pay up, buy at 5 times book, 10 times book, and they come and sell. So then that caps the upside, right? So there's no point building a investment case on flows. I think the case should be based on earnings, and then you see whether the multiple has come down too much or is at reasonable levels.
Interesting, you spoke about earnings and excluding OMCs or all marketing companies there. They are making losses, but the losses are also absorbing the inflation impact, on the second rung inflation impact. So on one hand, we are saying that the inflation is pretty much in control, which is there, but that inflation is actually being absorbed by certain companies here. Yeah. Excluding both of them on both sides doesn't look equal, right?
So that's a fair point. But the question to ask, right, is whether, firstly, the question to ask is if you have a temporary oil shock, how should we deal with it, right? And the choices are you pass it on to the consumer. Second choice is the OMCs bear it. Or the third choice is the government bears it, right? Now, if it's a temporary shock, that's what I said. The first one is you pass it on to the consumer, right? So the point is, look, if it's a temporary shock, which it is, right? There's no harm in not passing it on, keeping the economy stable. Right? I would argue it's okay for the OMCs to bear it. Even better would be that the government bears it by drawing down on the forex reserves. Right? So the way I'm thinking about the ideal situation would be, yes, we have to pay an additional $20-30 billion for oil this year. Let's pay for it by depleting our foreign exchange reserves, because that's what reserves are for. Reserves are for dealing with temporary shocks. Otherwise, why do we have reserves? Right?
True.
I mean, and the point is we're still sitting on $500 billion of reserves. So I'm actually okay with either of the two cases. Either you draw down the reserves or temporarily the OMCs absorb it and we'll recover it later, right? So there's no point passing on all the volatility because of a temporary shock.
You spoke about how earnings matter more than flows, and valuations matter. The one sector where we've seen some very strong outflows is IT, outside of financials. How do you look at that entire space and the evolving, dynamics of IT?
See, I'm underweight IT, right? And the way I'm thinking about it is that revenue growth will not come back, or a leading indicator of revenue growth will be that the companies start to add headcount. And if the companies are not adding headcount, it tells me that they themselves are not confident of revenue growth, right? Now, some people make the case that you'll do more work with the same number of people. I don't disagree with that, but the benefit of that improved productivity will go to the consumer. So you will not be able to charge for that additional work that you do. Because the way projects are priced in IT is that you say, look, this is the job that needs to be done, they bid it out, everybody calculates how many people will be required for how long, and they put a markup and they bid for it. So if more work can be done with the fewer number of people, the competition will ensure that the margins remain the same, right? So what I'm not seeing at the moment is headcount addition, which for me would be a leading indicator of revenue growth. And why I think that's happening is not because there's AI, that may come later. I think these Indian vendors are losing market share to the GCCs, right? So it's not that Indian IT is doing badly. If you look at Indian IT services exports, they're pretty healthy. It's just that people are saying, look, why do I need to pay a 20% markup or a 15% markup to an Indian vendor when I can do the work in my own GCC?
And what
The
about
relativity theory.
the shift towards fixed price contracts? You don't believe that?
No, but the pricing, even if it's fixed price contract, how do you set the price is based on your cost?
Based on hours.
See, this is different from when a Microsoft sells you an Office software, right? They don't say, oh, it costs me nothing to produce one more unit of Microsoft Outlook or whatever, Office. So I'll sell it for ₹1. They say, look, what is the benefit that ET now will derive from this software? And I'll price it so that if they derive ₹1,000 of benefit, I take 800 out of that. So this pricing is not in a IT product business. The pricing is consumer benefit downwards. In an IT services business, the pricing is cost plus, irrespective of whether you make that estimate upfront and make it a fixed price contract, or you say, look, I'll actually bill you based on my actual cost, but it's still cost plus.
Understood. Other than IT, where are the other spaces where you would sort of recommend caution right now?
So IT, I'm cautious. I think metals also is a place where I would not be excited. And
why is that?
The reason is, see, most of the metals play here in India is steel, right? And the reality is that Chinese demand is shrinking, and that Chinese demand is 50% of global demand. So it's very difficult to make a case that global demand will be growing. So then the bull case on metals, the bull case, which I don't agree with, is that the Chinese spreads are very low relative to history. But the history was when demand was growing, so spreads needed to be high enough to attract capacity. Now when demand is shrinking, spreads need to be low enough to drive out capacity. Right? That's logical. So we are now, I mean, my view is we are back to kind of like a 90s kind of situation. If you remember in the 90s, steel prices were in bad shape, and so were iron ore prices. So I think both steel demand is muted and iron ore capacity is coming on. So you're likely to see a situation where iron ore prices also correct. And then the Indian companies are actually iron ore margin is more important than the steel margin. So I'm cautious on metals.
Interestingly, you're cautious on healthcare and FMCG as well.
Yeah.
Why healthcare? Means that's a
No, I
thing
think
which
pharma has done pretty well. And hospitals, I'm not saying that 20 years later there won't be demand for hospitals, but I'm just saying, seeing a fair amount of capacity coming on in the sector.
Is that enough for a country like India? Because the alternate argument would be that we still we lack secondary and tertiary healthcare in our country.
No, I'm not saying, see, all of these, we have to look at over what time frame are we talking. So if you say 20 years later, is this enough? Obviously not. But in the next 3 to 5 years, are we likely to see a situation where a lot more capacity has come on than can be absorbed? My call would be yes.
And, and FMCG?
FMCG, as I just said, it's a margin issue, right? I think the margins are too high and they're losing market share. So I think they'll need to correct margins. This is what happened in the early 2000s also, right? If you recall, go back to the early 2000s, same thing had happened. Their margins had gone up too much and the stocks didn't do anything for a while. And eventually there's nothing wrong with the companies. They're very strong companies, very strong brands, but you still need to invest in them. And that investment requires a margin sacrifice.
And therefore, Anish, what are you positive on?
As I said, I mean, all the domestic cyclicals.
Okay.
Banks, insurance, cement, auto.
Got it.
Yeah.
Okay.
Capital goods?
Capital goods have run up too much. See, capital goods have seen a lot of margin upside already in the price. So while we'll see good revenue growth, I think the market is pricing in a further margin improvement, whereas they're pretty close to peak cycle margins. So I'm a little more selective in capital goods.
Especially the power ancillary companies, which now you have that alternate AI trade in India, which are data center trade. Let me put not AI, but data center trade, which is playing out in India. Do you see valuations now peak?
I'm not saying there's not going to be demand, but a lot of companies a lot of segments where there's no real supply constraint. See, you don't make money when there's just good demand. You need some supply constraint to actually make profits. And a lot of sectors have run up where there is no real supply constraint. You can see capacity addition quite quickly.
And the valuation, you think that...
Yeah, so the earnings estimates will disappoint. And then if the earnings estimates disappoint, then valuation automatically corrects.
Anish, you talked about banks as well. Any preference within banks?
No, so I would see banks as a sector globally that consolidates.
Sure,
right?
yeah.
There's no country in the world that has more than 5 banks, national banks. And then you have, so even if you go to the US, right, there would be 4 or 5 national players, and there would be then smaller regional players.
Yeah.
So I would stick with the large private banks, which have good deposit franchises. I mean, the key in a bank is you need to have a good low-cost deposit franchise so that you don't have to take much risk in lending. And so basically, that's my preference.
Versus the PSU banks?
So PSUs have kind of run up a lot, right? And basically, if you look at the deposit, if you look at deposit market share, that's still shifting from PSUs to private banks.
And within the NBFCs pack, are you seeing that
I think NBFCs
coming back?
NBFCs are overheated. I'm actually the one segment that I would worry about and from a lending perspective is personal loans. The market everybody has got into it. Growth is too fast, and I think it's already overstretched. MFI sort of situation is developing there, right? Where
But you don't see that bottoming out in terms of unsecured loans, which was a key issue maybe last 3-4 quarters, and many banks and institutions are now talking about that. Everything is now settling down.
Well, if you start growing, so my point is this, right? If you say, and this applies to MFI also, you said, oh, the water had come almost to my nose and I almost drowned. Now it's receded a little bit. Now I again bring it up to my nose and again I'll get into trouble. No? So the point is, if 3 quarters back, there was an over-leveraged situation, and you again start growing at 30-40%, then you will have an over-leveraged situation pretty soon again. I mean, in fact, that makes the case that I would make, that nothing has changed in 3 quarters that you should again start growing so rapidly.
Anish, the other debate about investing per the market cap. Would you say be market cap agnostic, or would you say tread with caution in SMIDs now, because that's where you had the meaningful recovery from the March lows?
Actually, I would prefer large caps at this point. I think the small caps is always a little bit of a minefield, right? You have to avoid the disasters. Actually, the way I think about it is this, right? You want to look for strong companies. If you're in a sector that's large enough for companies to be listed, right, then obviously scale matters.
Yeah.
So scale matters, then you're better off with the market leaders. So my point is that I would look for market leaders. That would be a criteria for evaluating the strength of the company. Now, if I'm looking at the OEM space, right, the car manufacturers or two-wheeler, the market leaders become large cap. If I'm looking at the tire manufacturers or the lighting manufacturers, the market leaders are small cap. So in that sense, you look for good companies across the spectrum. But what I fear is happening is that you're looking for the 10th company or the 10th biggest bank doing better than the best bank, the largest bank. And that seldom happens, right? That some 15th player will suddenly displace the market leader. It seldom happens. And you have to be very careful if that's the bet you're taking on a small cap.
And capital markets play, is that something which you're bullish on?
Capital markets are so there are two elements, right?
Yeah.
One is transactional and one is
exchanges,
stock-based.
asset managers, brokers.
But the asset managers and brokers are very different. Asset managers have a stock which doesn't change that much, right? Brokers is all transactions, and you have to distinguish, right? So the cyclicality in brokerages and exchanges is far higher than the cyclicality in asset managers. Right?
Okay.
Because if transactions slow down, the impact on... So I'm okay with asset managers, a little more cautious on because there the cycle is very close to peaking, and that's linked to the small cap cycle.
And on insurance, is it just because valuations have come off that it's looking attractive, larger consolidation played out, or do you see something structurally different playing out?
So I think the market is very worried about the regulatory landscape changing. And my view, and obviously there is some risk to this view, is that the supernormal profits are not with the manufacturers of insurance, right? So they're not with the insurers. The supernormal profits are in the distribution end of the chain. So if regulation gets tightened, it will be the distribution profits that will be squeezed, not so much the manufacturing profits. So I'm taking that call, and I have a long position in insurance.
Okay. Anish, great to have you in the studios today.